A bank approves a loan. No gold moves, no vault opens, no truck delivers cash. And yet new money appears. Not printed, not mined, created, with a signature. That's the uncomfortable starting point. In the modern economy, most money is not created by governments. It's created by credit, which raises a deeper question. If credit creates money, who controls the creation of wealth? Because money is more than paper. It's purchasing power, it's access, it's leverage over the future. And whoever decides who gets credit first, decides who gets to shape that future. Right now, this matters more than ever. Household debt is at historic highs in many countries. Corporate borrowing has exploded. Governments roll over trillions in sovereign bonds. At the same time, asset prices, stocks, real estate, private equity, have surged over decades. A coincidence? It's a credit story. Let's slow this down. Imagine you walk into a bank and ask for a $100,000 loan to start a business. If the bank approves you, it doesn't hand you existing deposits from someone else's savings account. It types numbers into a system. Your account is credited with $100,000. On the bank's balance sheet, two entries appear simultaneously. An asset, your loan. A liability, your deposit. Money has been created, not transferred. Created. This is how the majority of money enters the economy. Commercial banks expand the money supply when they issue loans. So in a very real sense, credit is money creation. Now here's where power enters the picture. Banks do not lend randomly. They lend based on risk models, collateral, regulation, and profit incentives. If you own property, have stable income, and strong credit history, you're attractive. You're risky, unproven, or lack collateral. You're not. Which means access to credit isn't evenly distributed. And since credit creates money, money creation isn't evenly distributed either. Let's look at where most credit actually flows. A significant portion goes into real estate, mortgages, commercial property, asset-backed lending. Another large portion goes into financial markets, margin loans, corporate debt issuance, leveraged buyouts. Relatively less flows into small high-risk startups, or low-income communities without collateral. This has consequences. When banks expand credit primarily into assets, asset prices rise. Housing becomes more expensive. Stocks climb. Those who already own assets see their wealth increase. Not necessarily because productivity surged overnight, but because credit expanded. Now consider the feedback loop. Increased collateral values. Higher collateral supports more borrowing. More borrowing fuels higher prices. The system rewards those closest to credit creation. It's subtle. No conspiracy required. Just incentives. Banks aim to maximize returns while minimizing default risk. Governments encourage homeownership through policy. Central banks lower interest rates during downturns to stimulate borrowing. Each decision makes sense in isolation. Together, they shape who benefits from new money. Here's the uncomfortable math. If money enters the economy through debt, someone must carry that debt. Every new dollar created by a loan corresponds to a liability, which means wealth, in aggregate, expands alongside obligations. When credit grows faster than real output, asset inflation often follows, and asset inflation disproportionately benefits asset holders. This is why wealth inequality often widens during periods of aggressive credit expansion. Not because effort disappeared, but because access differed. Now let's widen the lens. Commercial banks create money through lending, but they operate within a framework set by central banks. Central banks control interest rates. They set reserve requirements. They act as lenders of last resort. In crisis periods, they inject liquidity directly into financial markets. They purchase government bonds, sometimes corporate bonds, occasionally even asset-backed securities. This influences where credit flows. Lower interest rates make borrowing cheaper. Cheap borrowing increases leverage. Leverage amplifies returns on assets, and so asset markets respond quickly to monetary easing. Meanwhile, wage growth tends to move slower. The effect compounds over time. Now layer in government policy. Favor debt over equity. Interest payments are deductible in many jurisdictions. That encourages borrowing. Housing policies often subsidize mortgages. That channels credit into property. Financial regulations sometimes treat government bonds as ultra-safe collateral. That directs institutional demand towards sovereign debt. Each rule nudges the river of credit in specific directions, and rivers shape landscapes. Public perception often says wealth is created purely through innovation and hard work, and innovation absolutely matters. Entrepreneurs build companies. Workers generate output. Technology transforms industries. But underlying all of it is financing. Ideas without funding remain ideas. Businesses without credit scale slowly, if at all. So the gatekeepers of credit play a quiet but enormous role in determining which ideas become empires. Develop. Which industries dominate? Now let's talk about crises. When credit expands too quickly, risks build. Speculation increases, debt levels climb. Eventually, something stresses the system. Defaults rise, asset prices fall, banks pull back lending, and suddenly, money creation reverses. Because if loans are repaid faster than new ones are issued, the money supply can contract. This is the other side of the credit coin. If credit creates money, deleveraging destroys it. During downturns, those without access to fresh credit suffer first. Small businesses struggle. Unemployment rises. Meanwhile, large institutions often receive emergency support to prevent systemic collapse. Liquidity facilities, asset purchase programs, regulatory release. The stated goal is stability, and stability matters, but the side effect can be reinforcement of existing hierarchies. Those closest to the monetary spigot are often first in line when it reopens. Here's where the narrative becomes more uncomfortable. Credit allocation is not purely a market outcome. It's influenced by political decisions, regulatory frameworks, and institutional design. Central banks are often described as independent. Commercial banks are private entities. Governments legislate the rules. Together, they form a triangle of influence over money creation. Most citizens never directly interact with this structure. They experience it indirectly, through mortgage approvals, credit card limits, interest rates on car loans, investment returns in retirement accounts. But the macro structure shapes those micro outcomes. Now consider a simple contrast. Two individuals. One owns multiple properties and can borrow against them at low rates. Limited savings. When interest rates drop, the property owner refinances, borrows cheaply, and perhaps buys another asset. The renter sees housing prices rise further out of reach. Same economy. Different access to credit. Different wealth trajectory. Multiply that dynamic across millions of households, across corporations, across countries. On a global scale, wealthy nations borrow in their own currencies at low rates. Developing nations often borrow in foreign currencies at higher rates. When global financial conditions tighten, capital flows reverse. Exchange rates swing. Debt burdens rise. Credit access shrinks. The architecture of global credit influences global wealth distribution. So who controls the creation of wealth? At the surface, entrepreneurs and workers create goods and services. At the structural level, banks create money through credit. At the policy level, central banks set interest rates and influence credit availability, ultimately shaping the entire framework. Level. Central banks and governments shape the conditions under which credit expands or contracts. Wealth emerges at the intersection of productivity and financing. And financing is not neutral. It follows incentives, it follows safety, it follows collateral. In theory, credit flows to its most productive uses. In practice, it often flows to its most secure uses. Secure is not always the same as transformative, and that distinction matters. Because if credit consistently favors asset accumulation over productive investment, economies can become more financialized, more focused on asset prices, more sensitive to interest rate shifts, more unequal in distribution of gains. Now we arrive at the deeper tension. Money is created as debt. Debt must be serviced with interest. Interest requires income. Income must be generated somewhere in the real economy. Then income. Strain builds. If income grows faster, the system feels stable. Managing that balance is one of the central challenges of modern capitalism. And the levers controlling it are concentrated. Interest rates set by central banks, lending standards set by commercial banks, fiscal policies set by governments. These levers influence who can borrow, how cheaply, and for what purpose, which means they influence who can build, buy, invest, and expand. The creation of wealth is not just about effort, it's about access. Access to capital, access to credit, access to favorable terms. So when we ask, if credit creates money, who controls the creation of wealth? The answer isn't a single institution or individual. It's a system, a layered structure of incentives and authority, some transparent, some technical, some political, and largely invisible in daily life. Most of the time, the system hums quietly. Loans are approved, payments are processed, assets appreciate, confidence holds. But every financial cycle reveals the same underlying truth. Money is not merely earned, it is issued. And the power to issue it, even indirectly through credit, shapes the distribution of opportunity in profound ways. So the next time you hear that wealth is purely the result of market forces, consider the machinery behind those forces. Consider who decides the cost of borrowing, who qualifies, who doesn't, and who stands closest to the moment new money is born. Because in a world where credit creates money and money shapes possibility, the real question isn't just who works the hardest. It's this: who gets access to the future first?